All right, let's just dive right in. Welcome to today's Explainer, where we're breaking down the absolute foundation of personal finance. We're talking three crucial money concepts every single first job needs. Basically, everything you need to actually get started. We'll look at how to invest consistently, why time actually matters way more than the amount you put in, and what protects it all when life inevitably throws you a curveball. So if you're starting out and want to build a rock-solid financial base, you are in the exact right place.
Here's our roadmap for today. First up, what exactly is a SIP? Second, compounding. And finally, the emergency fund. Let's get to it.
Chapter 1. What is a SIP?
So picture this. You just started your first job and your friend is like, hey, just start a SIP. But what does that even mean? We actually often define things best by what they aren't. SIP stands for Systematic Investment Plan. And here's the kicker. It's not a fund. It's not some special scheme. It is literally just a method of investing. Think of it as a really good habit that's just been mapped into a financial system.
Here's how the actual mechanism works in practice. On a specific date that you pick, every single month, a fixed amount of cash is automatically debited right from your bank account. And that money goes out and buys units of a mutual fund. You can kind of think of these units like shares, right? Except instead of being tied to just one single company, they exist in this big pooled basket of different investments.
Now, because that unit price is always moving up and down with the market, your fixed, say 1,000 rupees, is actually going to buy you more units when prices are low and fewer units when prices are high. It's pretty clever, really. Over many months, this totally evens out your average purchase cost. You see, you aren't trying to bet on one perfect day. You're just spreading that bet out across time. This is an incredibly powerful concept, and it's what we call Rupee cost averaging. Let's actually see this in action. Take a 24-year-old who just goes ahead and starts a 1,000 rupee monthly SIP the very week she gets her offer letter. She literally never checks the market before investing. Boom, 5 years later, she's got a solid portfolio, and more importantly, a habit that never once relied on her mood or the daily news cycle. Now compare her to the guy who waited for, quote-unquote, the right time to invest. You know the type, obsessively checking the news, waiting for a market dip that never quite felt like enough. A whole year goes by, and guess what? He still hasn't even started. So the absolutely crucial point here boils down to this: consistency, not prediction. That SIP investor, she didn't outpredict the market at all. She just showed up on schedule. That is literally her entire edge. A SIP isn't some magic return generator. It's just a structure, and it removes your two biggest financial enemies, simply forgetting to invest and trying to be way too clever about timing the market. But okay, we do need to bust one massive myth right here. A SIP absolutely does not guarantee a profit. Remember, it's a method, it's not insurance. Getting how a SIP works is step one, and honestly, the best SIP is just the one that starts today, with an amount small enough that you'll actually stick with it. But step two? Step two is knowing what that 1,000 rupees is actually doing in the background, which perfectly tees up our next concept.
Chapter 2. Compounding. The core financial engine.
Compounding. Guys, it's not just interest. It is interest on interest. Think about it. In year one, your money earns a return on whatever cash you put in. But in year two, it earns a return on your original amount plus everything it already earned back in year one. So every single year, that base just keeps getting larger and larger. Now, this is entirely different from simple growth. With simple growth, you only ever earn on that original amount, year after year, no matter how long you leave it there. Compound growth, though, it acts exactly like a giant snowball rolling down a hill. The bigger it gets, the faster it gathers even more snow. It's wild when you really look at it. All right, let's put some numbers to this with a little riddle. Two people invest the exact same amount every month. Meet friend A. They start investing at age 25. They put in a consistent, modern amount every single month for exactly 10 years, and then they just stop. At 35, they stop completely. No new money goes in, the existing money just sits there and keeps compounding. Now meet friend B. They start at age 35, exactly when friend A stopped. Same monthly amount, but friend B keeps going for 25 straight years, all the way to age 60. So friend B put in way more money overall, right? 2.5 times as many years of actual cash out of pocket. So obviously friend B should end up with way more money at the end, right?
Well, not necessarily. See, friend A's money had 35 years to compound, while friend B's money only had 25. That extra decade of compounding time can completely mathematically outweigh a decade of missing contributions. Now, obviously, this is just illustrative. It's not a strict guarantee, because real-world returns do vary and they're never perfectly fixed. But the underlying math principle absolutely holds up. Time in the market matters so much more than most people assume. Time is way, way greater than timing.
So the absolute biggest takeaway here is the real cost of waiting. The lesson isn't you need to invest more money. The lesson is you need to start now. Literally every single year you wait is a year of compounding you can never get back, even if you throw way more money at it later to try and catch up. They always say the best time to start compounding was years ago, but the second best time is today. And honestly, this is exactly why a SIP works so remarkably well with compounding. It's just small, consistent amounts left alone for as long as possible. But compounding only works on money you don't touch, which is exactly why we need to talk about what you must do before you even start investing.
Chapter 3. What is an emergency fund?
Okay, imagine your investments are compounding beautifully. You've got your SIP running on autopilot, everything's great. Then, boom, out of nowhere, your bike completely breaks down and you need 15,000 rupees like right now. What happens next depends entirely on whether or not you have an emergency fund. This is the one single part of your money that is literally meant to just sit there doing absolutely nothing. We're talking 3 to 6 months of your living expenses kept completely separate from your investments. It's your ultimate financial safety net.
So where should this safety net live? It has to be kept somewhere you can access immediately, no questions asked. Think a basic savings account or super liquid option. It should never, ever be in the market. Absolutely no stocks, no mutual funds for this specific bucket of cash.
And that actually brings us to a really major realization. This money is boring on purpose. Seriously, its entire job description is just to be boring. It doesn't need to grow fast. It doesn't even need to beat inflation. It just needs to be there, untouched, for the exact precise moment something goes sideways in your life.
Let's look at how this actually plays out in real life. Take character A. They have zero emergency fund. All their money is tied up in SIPs and mutual funds. It's all working hard. Then the bike breaks down. Character A now has 2 incredibly stressful options. They either break their SIP and sell off investments at a totally random, probably terrible time in the market, or they take out a high-interest personal loan just to cover the mechanic. Either way, their whole financial plan is wrecked. That compounding we just spent a whole chapter talking about, it just got interrupted at the worst possible moment. But now, look at character B. Same exact income, same exact SIP, but they have 4 months of expenses set aside in a boring savings account. The exact same bike breakdown happens. Character B just pays for it from their cash cushion. No expensive loan, no selling investments, zero disruption. Their money just keeps compounding exactly as planned, completely undisturbed by the emergency.
And guys, this right here is the true purpose of an emergency fund. It is not about earning returns on that specific money. It's entirely about protecting the returns that everything else in your portfolio is already earning. It's the shield.
So I've got a quick gut check for you. We like to call it the 3-month test. If you couldn't work for 3 months starting today, right now, could you cover all your living expenses without touching a single one of your investments? If the answer is no, then that is the absolute first gap you need to close before you do anything else. And there you have it, your ultimate starting trio, a SIP to build unbreakable consistency, the magic of compounding to let time do the heavy lifting, and an emergency fund to protect the whole shebang. But I want to leave you with this one question to really think about. If your primary income stopped tomorrow, would your financial engine keep humming along, or would the whole thing just fall apart? Build this foundation today, because trust me, your future self is already watching. Thanks for hanging out with us, and we'll see you next time on The Explainer.